Welcome back. You're still watching Finweek Money Matters. The investment industry continues to be challenged on how it defines performance, how it delivers value, and how it measures success. Now, one way to enhance the industry's value proposition to clients is for the industry to evolve to a point where it begins to frame performance in terms of the investor's objectives. In studio to discuss goals-based investing is Nerina Visser, Director at ETF-SA, and Anne Cabot-Alletzhauser, hope I got that right, Head of Alexander Forbes Research Institute, and we'll get that right. Let me start with you. First, you can correct me on the surname because I've been trying to rehearse it, but goals-based investing, is this a new concept?
Totally not. As a matter of fact, if you go back to the 1970s, and you look the way people manage sort of trust fund assets for high net worth individuals, everything was based on goals based. How much do you need to live off of the year? How much do you need to pass on to your heirs? How much do you need to do this? And so the concept has been around for a very, very long time. But the industry morphed, and it morphed very dramatically. And what really happened with the industry is that you get a mass democratization that takes place in terms of who can actually access investment markets. So you get the growth of the unit trust industry, they call them mutual funds in the US. You get the growth of things later on, like the shift from defined benefit to defined contribution funds. And with that mass democratization, you have a challenge that the industry faces. How do we make this simple? How do we make this accessible to the masses? We can't sit there and do individualized solutions for everybody. So what happened is that you get this dramatic shift that takes place in the industry where the easy thing to sell is performance reporting. And you get the buildup over the years of surveys, you get the buildup of rankings and Raging Bull Awards and all sorts of stuff that keeps perpetuating that it's the performance that's important, not fulfilling a specific goal. And that's easy to sell, and everybody can buy into it.
Nerina, is this very accessible? It just sounds also complicated. So if I'm an investor, I have a goal, and there are all these funds, and like Anne said, these Raging Bull Awards. How do I make sense of all of this?
I think the first step is to identify what are your goals. What are you saving for? What are you investing for? What is the time horizon of your investments? And I think one of the first steps is to acknowledge that your saving and investment goal is not a single goal. You've got different goals. And think back of the era when our parents sort of kept money in little envelopes for different categories. It's exactly the same concept. Saving to put down a deposit on a house in 3 years' time is a very different savings goal than retiring a millionaire in 20 or 30 years' time. So defining your savings goal into discrete almost components is the first step. The second step then is to say, right, what is my return requirement or my goal for that? Can I afford to not meet this goal? So now you start looking in terms of performance measurement as I'm not going to meet my goal, which is a very different risk concept than the standard deviation of the returns of a particular fund.
Yes.
And I think what you also find is once you identify whether a particular goal is a want or a need, your risk sort of appetite for those two different goals differ quite substantially. So where it is a need, you actually can't afford to take nearly as much investment risk as where is it a want. If you miss on, I'd love to have a yacht in the Mediterranean and sail around it for 3 months of the year. But if I don't meet that particular investment goal, it's not going to be the end of the world. But if I don't have money with which to retire, that might be the end of my world as I know it. And that's really the fundamental difference. So the products that we use to manage our investment don't need to change. It's really about our approach to how do we define our investment goals and how do we measure the performance of those investment goals.
Actually, I'm going to differ with you. The products that you use are going to be very different. You can't just shoehorn a unit trust in there and cross your fingers and hope that the unit trust might get you to that goal.
Okay,
so it's a very different strategies that are going to get you to very different goals, and that's one of the problems of the way the industry is structured.
So the tools are just as important.
The tools are just as important.
So I think it's a fair comment that Anne makes, absolutely. We have actually these appropriate investment products, but they're not marketed that way. They're all only marketed on performance, on ranking tables, on beauty parade basis. And if you categorize investment products almost according to 3 major components, the first one can be performance. But the second one is about almost your income component of that, and that might be a very important aspect of your goal that you need to find. And the third one is capital protection. You might actually find that protecting the value of your investment is a lot more important than achieving some nominal goal. So focusing on those different criteria of an investment product will really assist you in implementing goals-based investments.
Yeah, and I'm going to bring you in the discussion.
Yeah, I think for me, I mean, if I go to my financial advisor, for example, to what extent is this, you know, something that they will understand and be able to help me with, or is there a lot of education that's needed in the market?
That's the scary thing, because they think they do it already. They think that the fact that I've asked you what your goals are and you've told me what your goals are, that's all they have to do. And then they go out and they go to the Raging Bull Awards, they look at the surveys and pick the funds and say, well, they are the top performing funds. And that's where the mismatch takes place. So you asked me whether there's a new concept, and in a sense, it's very much linked to the kind of concept that used to direct pension funds, which was we would particularly defined benefit funds. We knew what the liability was. We knew there was an income requirement for people when they retired, and we could create an investment strategy that would match that variability, that ability to create that income stream post-retirement, you know, as you got closer and closer to retirement. And so pension funds sort of did that. But when we moved from defined benefit funds into defined contribution, where suddenly everybody sort of gets to pick and choose what they invest in, then the performance thing came back in, and people forgot that what they needed to match was the variability of how do you make sure you get the right income stream at the end. It isn't about just accumulating as much as you possibly can, because when you go and buy an annuity, that price of that annuity is changing all the time. So you have to find something that immunizes you to that variable change in the price of the annuity. So it's not as easy as just accumulate as much as you can. So it's a lot of new challenges in there from investments. And I'm amazed how many asset managers get scared off because they don't know what to do. You know, so a lot of asset managers won't compete in the space because they don't actually know how to do this.
Nerina, I want to pick up on a point that Anne made earlier on with you know, these Raging Bull Awards that you've got, and I want to go back again as an investor. I'm trying to make this a very difficult decision. Should I be ignoring you know, these press releases or companies that say top performers in this best fund manager? Should I be ignoring those? How do I make sure that I do choose the right fund manager then?
Maybe you should pay as much attention to that as you do to who's the latest Miss South Africa or Miss World. Because at the end of the day, its relevance is about as much as a beauty parade. And, you know, maybe the other question to ask yourself is, having the best performing fund is great when the return of that fund is 25 or 30%. When the best performing fund is minus 10% and the rest of the herd is at minus 15%, you still have the best performing fund. But does that assist you in achieving your goals? You probably will have sleepless nights if you know that your expected return on your investment is always going to be minus 10%. So ask yourself, how relevant is it? You don't necessarily have to ignore it, but you've got to match that to your specific goals and your requirements, and the ability of only judging an investment on its past performance. How applicable is that to you actually meeting your investment goals? And maybe to come back to Jana's question regarding, can financial advisors do this? I think clients and investors are just as much, it's their responsibility also to challenge the financial advisor and say, don't talk to me about the performance of a particular fund that I'm invested in. Talk to me about how close am I to achieving my goal that we've set up, and force the conversation back to measuring performance appropriately for your particular risk profile.
Now technologically, we can start to do that. We can start to, you can take every individual in a pension fund and you can actually map them where they are in terms of their course to meeting that retirement income replacement that they need to. But I wanted to put a little guilty sign on the front of me saying, well, I'm Alexander Forbes, and Alexander Forbes Performance Survey reports into my team, guilty as charged. And we were talking about this last night and said, you know, the only way you're going to change the industry is change the industry, and the industry responds to what it's rewarded for. So if you've got Alexander Forbes' survey saying, whoa, you're number one, you know, that's a problem. So what happens if we now launch a survey that says, how well does that manager do in a goals-based context? Can they show us product? I mean, that's one of the questions that we thought we'd talk about today. Are there products out that actually do that? Well, there won't be products until people demand it, and they won't demand it until they see that it's working, and they won't see it's working until someone goes out and measures it, and says, that worked, that guy knows what he's doing. Now, we have a liability-driven investment part of the survey that shows how well are people able to manage the liabilities, which is sort of what the pension funds do. But now let's extend that to products that the real person invests in, the guy in the street.
And I guess the measurement challenge there is really to say measure each fund against its mandate or its stated intention, not relative to some arbitrary market index or a benchmark or its peer group. And that's the challenge. Don't ignore rankings, but I would say ignore rankings that only look at performance. Start focusing on rankings that actually look at how well is this particular product meeting its stated intention.
Ladies, I'm going to have to leave it at that, but what I got from this is you do need to know what your investment goal is, know what your time horizon is. Having the product is just as important as that, and do your research. It's not just about looking at who was the best fund manager over the 5 years that they say.
You need to change the industry.
We need to change the industry. We're working on that. Thank you so much to all my guests today. That's it.